All right, everybody, welcome back to another episode. Went in a different direction today. A lot of the conversations we have are more on like the DeFi app level, or we're talking about, data infrastructure a lot, et cetera. This was a really, really refreshing episode to talk about maybe a missing piece of DeFi, which is settlement, a universal clearing layer. So we had a great conversation with James. He's the co-founder and CEO of Pascal Protocol, which is a protocol that is building and bringing to market a universal way to settle transactions to allow better capital efficiency for assets, on these trading venues. Really interesting conversation. James has a lot of experience, not just in crypto, but his TradFi life is very interesting as well, as you'll hear. But we got into quite a bit, and safe to say that if they are successful, then I think that we, in terms of like the apps and the apps that are possible to be built on the blockchain, are just headed in a massively positive direction. So definitely tune in. This is one where I tried to ask James questions to get it dumbed down enough where everybody can understand it. Hopefully, I did a good job for you, but I think you'll enjoy it. There's definitely big things coming on Arbitrum coming up next week when they launch and they TGE. So, if you enjoyed the episode, please like and subscribe, and we'll see you on the next episode. Take care. All right, we're back with another episode of Proof of Vision, everybody. Thanks for tuning in. Really excited to kind of bring you a different conversation today. I think we focus more on like apps than normal on this show. And it's really good to bring in a protocol that's building infrastructure that other apps can build on top of as well, which I think is going to be critical, and we'll get into it a little bit more. But happy to bring on James. James is the co-founder of Pascal Protocol. James, how are we doing?
Very good today, thanks. Yeah, it's a busy day. There's blowing a storm outside of my window here, about 40 miles north of London, but generally things are going very well, very busy. TGE brings so many interesting conversations as well as an enormous amount of work.
Absolutely, absolutely, and it's an exciting time for you guys for sure. Which definitely want to get into TGE a bit here in a little bit as well. We got hit with a massive storm yesterday, which is crazy. Anyway, I feel you on that. Let's start off. Let's talk about your background a little bit. How'd you get into crypto? Maybe previous projects you've worked on in crypto. But first, what brought you into the space? What kind of got you into the rabbit hole?
Yeah, certainly. I think it's maybe the advantage and disadvantage of being that much older than everybody is having seen a lot of different things happen before. And I'll tap into 50 next year. But the background, really, really short. I've been in trading and trading systems for a very long time, since finishing my physics degree in the mid to late 90s and coming into the market. And I have tried everything from open outcry. So started with color jackets, waving hands in London, a little bit in Chicago, seeing the evolution, being one of the first architects of high frequency trading. I won't go too much into that other than to say I've touched every single asset class. And I worked very, very closely with Howard Lutnick. A lot of people I meet in crypto have worked for some financial institution or other. If people were to go back and review the investor course Respeed, which was the big listed entity owned by Cantor, they would find for a few years that I was the sort of person alongside him on the call giving answers on where the technical direction was. So a fairly senior role in a business that was rebuilding itself post 9/11. So I got to know him professionally, not personally, but professionally reasonably well over that period. And then all of that rolled through until about 2017. I was tapped by a group to come into crypto. I had some experience around it. I'd worked with a lot of the people who'd gone across to BitMEX. A lot of those guys were in the German exchange before. We'd worked on what we called the constant maturity future. The world would now call them perps. If you go and look those things up and look up the patents, you'll find my name on those. But I think they're co-invented by quite a lot of people over a long period. And the project that tapped me up was trying to build like a crypto.com competitor, raised at the absolute height of 2017. Really brought all its capital together, and then lots of Russian influence that didn't take it in the right direction. 6 months later, we filed some of the reg applications for them. Myself and a bunch of the other guys left. I did a few things in crypto for poker. That was with some of the largest poker entities in the world, with groups that were working underneath Entain, which is the largest gambling entity in the world, listed in the FTSE 100 sometimes, sort of in and out. And we built systems for them to be able to take top ups for professional tournaments in crypto. In casinos, we delivered this really good product for the casinos in February 2020, which is the worst timing for casinos that has ever been in history, because they all shut for about 18 months from COVID. So coming to the end of that, I joined with this group and we started building a few projects and dexes. We have a lot of experience building financial market products, and then we span this out of a venture builder. And I've been working on it in some form now for about 4 years, but 3 years full time we've been in this until it was spun out.
Nice, nice. Well, I guess, one advantage that you do have, obviously, you mentioned, being as old as you are, is you've been through how many cycles in this industry now, right? In some form or another, which is rare, actually. Most people have not gone through that many cycles in this industry and lived to tell the tale. So you've got that going for you, at least, if nothing else. So awesome. So you kind of, jumped into the space, really started building, right away, right? I mean, I think, like, uniquely for you, you kind of had this, this TradFi view of the way that these capital markets work and operate, and then kind of bridging that over to DeFi. I would imagine is what usually sucks people in, is kind of this blank canvas of DeFi, right? Where you can actually make significant technological change and breakthrough. Whereas, I've heard a lot of people say this about TradFi, where they felt like everything had already been done. That there wasn't a whole lot more to really do, which is something really, really interesting I've been picking up on the last couple conversations we've had. So let's talk about Pascal a little bit. You guys talk about kind of like the universal clearing layer. First and foremost, for the listeners, what is clearing? Let's take it to the fundamental level. What's clearing? Why is it so important in traditional markets, and why is it so important in DeFi? And what has it been? Why hasn't it been solved for, I guess, in DeFi yet? And what kind of problems are is there?
Sure. So clearing is the post-trade process that manages margin, liquidations, and defaults, and prevents one person's losses cascading through the entire system. So DeFi's largely ignored it, because most of the protocols handle their own position in isolation rather than creating any shared risk infrastructure. But what that means is the amount of collateral that's locked up in DeFi relative to the amount of risk is just off the charts compared to TradFi. The amount we would expect to squeeze, the juice we would get from a piece of collateral in TradFi, would be 10 to 15 times more than we see out of it in DeFi. And really, that's the big difference. That's the end user value. Now, in TradFi, we take that for granted. We want to see that. We want to see those pieces of mechanics in place. But from DeFi, maybe we are a little bit blinkered. We think we've got some fantastic products, and we have. But what we don't know is what good looks like. What's really scaled liquidity feel like. And it is so much more. There is so much more for us to do. And it unlocks things like real world assets. It brings far more participants on chain. So it's a big key piece of unlocking more use of DeFi.
Gotcha. What do you think some of the it's kind of this one of these unsolved, I guess, layers, in the space. I've heard, really one other protocol I can think of that was trying to build something similar. It's called Everclear, where they were kind of trying to decentralize the clearing process with solvers, kind of competing for liquidations and things like that. But, like, taking it to, like, the exchange level. What are some inefficiencies right now that you see because there's not an efficient clearing layer on top? Like, what are some of the main things that users could maybe understand or wrap their head around?
So I think There's two neat questions in there. I'll try and give them both some clean separation. The first one, groups like Everclear are solving clearing of payments, the settlement and movement of cash between these different entities that need an awful lot of netting between them. That's different to the clearing of derivatives. So if I look at CME, I look at ICE, I look at Singapore Exchange, they have 50% of their revenue from this esoteric thing called clearing. Well, what is that? That's the area that we're looking at. So when I look at it more holistically across the whole business and I say, well, how much capital is locked in the business for the amount of trading that's going on? And I look at something like CME, it's about 7% of the total trading volume is represented as collateral in the risk model. And I look at it in crypto and it's more like 70%. So that really says, actually, just the money's here today, just the people who are involved, the amount of turnover volume we should have should be an awful lot higher. And that's your starting place for it. Say, okay, well, why? Well, let's take something really, really simple. Let's take somebody doing a statistical ARB bet. That's a bet on two different products traded against each other. Let's pick Ethereum and Solana. Right, make it even simpler. Let's say Ethereum versus a basket of L2s, Ethereum versus Arbitrum, Optimism, and a few of these. Now, we know that if the Ethereum price goes up a lot and the fees go up a lot, then more moves across to the L2s, and then they should track up. Yeah, and if the L2s go too far, then Ethereum needs to go up to compensate. The two move together. They are super related. They are related in the same way that crude oil and petrol prices are related. People don't tell us on the news that the oil price is going up because we all work in oil refineries. It's because it affects us and our fuel. So when Ethereum goes up, it affects Solana, it affects Arbitrum, it affects Optimism. Now, if I have to go and put some money down and I go and say I'm going to put 10% capital down for what I've got as exposure to Ethereum, that's great. But if I'm selling the other one and I put another 10% down, well, actually, the market's risk against me is much, much lower because these things are moving together. So I should be getting a credit back for putting the other trade on because I've reduced my exposure rather than increased it. Even though the total amount of size has increased, my exposure is reduced. That's portfolio risk. Again, this is another of the terms that so many of the exchanges have gone, oh, portfolio risk. That sounds like a good thing that works well for people, and it is. And then they've implemented it in a way that's not really portfolio risk. So they will say portfolio risk, and they will mean all of your assets can share and move the P&L around. I mean, the amount of stuff that we will lock up in margin is lower, and that's different. That's new. So it really is about them freeing that asset up to make more trading available. So if I've freed that up and suddenly my portfolio doesn't have as much locked asset against it for that particular bet, gamble, hedge, whatever it is, I can put that to work elsewhere and I can get more out of that collateral, more out of that trade. So I'm really able to bring more trading for less asset. And that's why CME is roughly 250 times the size of Hyperliquid.
This episode is brought to you by Pendle. Pendle is a leading protocol in the DeFi yield sector, operating as a permissionless yield trading protocol, facilitating the tokenization and splitting of any yield-bearing assets in DeFi. This allows users to speculate on future yield or earn a fixed rate on their assets. Learn more at pendle.finance. To put this in terms, simplify it a little bit, right? So with this clearing layer, right, you can enable basically traders to be able to take out more margin against their base assets than could currently be possible due to the risk models that these exchanges have put in place. Is that safe to say?
We're really fine tuning. We are holding the appropriate amount of margin for the risk that they take on, rather than just adding up all the positions and dividing by a percentage. If the positions are inverse to each other and have a correlation, then that reduces your effect. If they're not correlated, then you're going to pay probably the same as you would elsewhere. That's massive in terms of trading. If you think about all of these different protocols trying to bring real world assets on, well, real world assets like treasuries or metals, they don't trade as spots. They trade as derivatives. They trade on CME. They trade on other places. If we want to enable that for everybody around the world to do it, we need to enable them to trade derivatives. They need to be able to trade different delivery periods, because I care about hedging when my metal's going to arrive, not about the price tomorrow and what the funding rate for the price tomorrow is. So I want to be able to structure these trades. And as I structure these different trades together, I want to put the margin down that represents the risk, not the margin that represents the sum of everything I've ever done by some arbitrary percentage. that is okay if you're looking at one asset. It's more complex, certainly more complex to do on chain, but that's what we spent 3 years working on, 2 years building.
Gotcha. Okay, so that makes sense. When it comes to implementation, right? I think, in terms of business strategy, like go-to-market strategy with this kind of an infrastructure, um, I think you guys have elected to kind of have apps build on top of this layer, right? One of the first, I think, is Jetstream, Jetstream Trade. So, talk about that a little bit. Where is Pascal kind of monetizing this, or are you monetizing it yet? And is the way forward for you guys where you're having more of these front ends built on top of it, or are you guys going to spin out your own products as well on top of it?
So Jetstream is something that we've built because if you don't use your own app infrastructure, why would anybody else trust it? So it's been running now. In January, we've had a relaunch with a rebranding because we did some work on splitting that to make it cleaner. That's going well. It works well. It settles well. We've run multiple future cycles on it, so that operates cleanly. It shows that it operates well. That's for crypto products. If I want to launch an interest rate product or an FX product, it wouldn't necessarily be sat in the same pool. That would be something that people would build on top of Pascal. We've put a couple of LOIs out there. We've got a few more to come from people who are building an intent on launching. One of them that's public is Treehouse that have worked on benchmarks. People want to trade different interest rate products based on the benchmarks for staking that they provide. If I trade those, they all have different time periods for them because they tend to be forward rate agreements. If I individually margin all of those under an ISDA or something, it costs a fortune. If I do it on a clearing platform, it drops the cost massively and massively increases their utilization. Some of the rest are real world asset guys who know that all of the trading is on derivatives. They need a platform to be able to build those. They need it to be in DeFi. We fit that well. So Pascal will have multiple people building on top. It will be an infrastructure. It monetizes it by collecting 25% of the transaction fees. The platform set their own transaction fees, and then it picks up 25%, and they have to set it to make their market work. But if they're collecting it out of the margin pool, which is the norm for that, then that's how it takes it, and it distributes about 80% of what it collects back out to stakers, and the rest goes into its treasury to keep itself building and moving forward. Interestingly, the appetite has come from TradFi entities that want to disintermediate banks and want to build markets amongst groups of definitely what we would think of as professional traders for other assets, things that aren't on chain at the moment, and they want to find mechanics to do that. And what they were missing was a clearing platform. And I've got a conversation straight after this with one group, and that marketplace is roughly 100 times bigger than crypto, the first one. So these are good entities to go and build that out with. We think Jetstream can be huge. We decided to make that everything goes back out in volume, so all the token ownership will go back out to the community because it's our proof project. So anything that trades, we're doing a point scheme, very hyperliquid inspired. But where the volume adoption will come is OTC. There's huge amounts of OTC markets in options. When we bring options online, we want to try and bring that clearing across. The only place to do it right now is Deribit. Deribit's probably got about 20% market share when you account for OTC, 85 if you account for everything that's listed on exchanges, but 20% if you account for OTC. We think there's just a straight capacity issue for more options clearing. That gives it incredibly good revenue numbers, but we need to build the futures market first. So we're trying to get as many people as we can come in, be part of that, grow it up organically. It's not got some huge amount of liquidity going out to market makers from us. It's very organic to try and grow that, but we need more partners in that space. And Pascal will see monetization out of it. Jetstream will see its own monetization, but 25% is flowing back to Jetstream and 20% out to stakers. We'll also do some airdrops of Jetstream to the Pascal stakers that stay with us long enough through that period to try to incentivize them to stay there. And hopefully some of the other platforms will do as well, and they'll airdrop to the people who are building on top of that. But really trying to get people interested in hardcore TradFi infrastructure, the stuff that is the next scale. Web 2 really grew when Amazon came along and Google came along. Before that, it didn't. You need these apps to build on top of. It's not enough just to have a TCP layer.
Right. No, it makes sense. I'm curious about from an implementation standpoint or proof of concept standpoint. Does this Does this infrastructure, like I think about exchanges right now, and obviously I think there's two models that are kind of been prevalent in DeFi, right? There's the order book model, and then there's like the AMM based model. So you've got your GMXs, you've got Avantis on base that's kind of got this AMM model that they're falling back into, and then you've got these order books like Hyperliquid, Lighter, I think is another one, GTE coming online. But anyway, for Pascal and kind of this clearing layer, like are you able to plug in and offer to both models, to the order books and to the AMMs, or is it more optimized for one or the other?
So the clearing layer, because it could be OTC, and
Yep.
the core place that we're going after, they could arrange these trades by voice and then book them in afterwards. So this is about people being able to make sure that their counterparties aren't defaulting. So it's really agnostic. Now we've built an order book matching engine and put it alongside it, and that's what Jetstream runs on. It does it fully on chain. So if you are a textiles market in Central Asia and you want to launch a trusted marketplace where you can see what the exposure of the other people are that you're delivering your textiles to without the banks taking 30% of your cash to guarantee it happening, then you could do that using this protocol and you can use our order book and get going. But if you are building a treasury market and it's all OTC between group of entities that you have internally, then you could also launch that, maybe have a Ceph or have another exchange sat on top of it that's doing your execution, and then use us for clearing, which may or may not be a model that we've seen and talk to people about. So it's really flexible. This is maybe the tricky piece, is that there isn't anything like clearing. There's no clearing infrastructure for derivatives in DeFi. It dominates the P&L of the large exchanges in TradFi, and they would very much like us to not know that, because that way we're not competing, and we never will compete until people can turn over their asset 10 to 15 times, not 1.5 times. So it's not about the fastest thing out there. The options market is not going to come and trade on an order book. It's going to trade OTC. People are going to put structured products together. It doesn't matter how much speed there is, because people are going to spend a day and a half working out that that's the right trade for them. They're going to conclude it OTC, but then they want to know that it's guaranteed and it will be delivered in the right way, and they need a clearing layer. So it's sort of independent direction from the rest of them. You could technically take something like Hyperliquid, book all of those trades into futures, pass them into us, and we would run the book, massively reduce the margin, and all of the execution could remain exactly the same as it is today. It's not a pitch that we're after right now. We've got plenty of things in front of us, but the same applies to many, many different crypto places. We'd like to see more sharing of that risk layer and that risk data, and let people have all sorts of innovations in price discovery.
Gotcha. No, it makes a lot of sense. I mean, and the reason I asked that question is just it seems like, again, like in terms of like the addressable market for you guys, I think you already said you have a lot in front of you, but it just seems like it's so vast, for something like this, that, if executed well, right, and if it performs as advertised, it could really create, a lot of new primitives on top of obviously the base primitives that are being built right now in DeFi.
Yeah.
The question I have, really on the other side of things, though, is like, you've got this clearing layer. Usually you've got the market makers, that are involved, providing liquidity, making sure that these things happen, from like an actual execution standpoint. How does this help market makers, I guess, is the base question. And if you can divulge it, like what kind of market makers have you had that are maybe interested in this, or maybe already confirmed to be utilizing it?
Well, the market makers are going to be on a platform by platform basis. So if somebody wants to launch a metals market, I know who they'd approach. You go and talk to people like Marex, but you wouldn't use the same market makers that you would if you had an FX or a crypto market. So the Jetstream, the principal first market maker is Toa Capital, who are they're a big trader. They might not be a known name because they don't market make tokens for people. And the team is sort of ex Barclays, Barks FX team, and related to sort of Mahi Markets and all those sort of huge, great FX giants. So they're a very effective, very capable guy. And I would say the CEO there really understands that if entities like us win out in the long term, then he gets to trade with a lot less collateral. So he would like entities like us to win. Some of the rest of the prop traders who are putting trades through at the moment and doing some of the larger trades are essentially people who are running books for treasury companies. So if you're a treasury company and there's a ton of these guys now starting to trade, they are asking and engaging prop traders to trade on their behalf. So people who want to buy Bitcoin with treasury and so on, they're trying to maximize that by taking spreads between the basis out and all of that. That's hard to do in perps. It can be very costly in perps. There are really well established strategies for doing that in straightforward futures. So we are seeing those entities showing interest. And where we're competing really is with people who will otherwise go to OTC. So if I'm a big on-chain foundation doing a hedge, I don't go to Hyperliquid, I don't go to Binance, I don't put a perps trade on as a hedge. They go OTC and probably buy an option at the moment. Sometimes they should be doing futures with us. When we get to our options market, they should be booking that through and running their deltas in the right way. But that's where we're competing. People who are finding it very expensive to hedge elsewhere and need a proper set of mechanics to do that with, so we can deliver that. So it's maybe a bit different. We don't look at Hyperliquid and say, how do we get 80% of their market share? I mean, Da Vinci, IMC, Flow, we know who the guys are. We know how much they're turning over and what their business model is with it. But it's not a sticky long-term thing that we want to get into. It's how much is your incentive against it? It's great for them. I want to make sure that there's a hedging model. And if we do get that hedging model, that feeds retail like nothing else. Because those hedging guys are not sensitive to bid offer spreads, which means that they're pushing edge back into the market all day long. At the moment, that happens OTC. So those guys are doing it OTC. Those people are then taking that and laying it off into different sorts of perp structures. But the retail's not getting it. The retail should be able to be part of it. They should be just as equivalently part of that.
Gotcha. No, makes sense. Makes sense. And then in terms of chain, right? I'm assuming you're building this to be agnostic to chain, where you can build it on the EVM, you could take it over to Solana, or am I wrong there? Like, what are you guys focusing on?
Unfortunately, wrong. It's fortunately we're on Arbitrum. We put it on an Orbit chain because we needed to be able to drive the throughput in the right way. We found ourselves like a week and a half after we launched. This is one of the reasons why we relaunched was to move it to Orbit. We found ourselves 2 days into our launch being the second biggest user of gas on Arbitrum, and just that was us in beta mode still. So I mean, if we had the volumes are smaller today, but the number of transactions are much higher. If we had this number of transactions, we'd be blowing the doors off the gas. We had to go and do Orbit and everything related to that. So it's not super portable. You really want to make sure that your risk is fungible. The idea generally, though, is that people can execute from anywhere. So we use USDC. There's a protocol part of USDC called CCTP. So if you've got a wallet on many of the other protocols, you can come and interact with us with your USDC on that chain, and it brings it across using CCTP directly into us, and you can get a native experience with your cash that's sat on, for instance, Solana. So that's where we want to be. You shouldn't see. Yeah, I shouldn't be having to choose whether it's VHS or Betamax. I should just be choosing the video.
Gotcha. No, that makes sense. Actually, I like that. Kind of leaning into CCTP. Have you guys thought about any backups there though? So, like, let's say CCTP ran into an issue. I talked to a lot of protocols that are thinking about this, and like they're choosing like CCTP, and then they're also building with other interoperability modules as backups, just in case something were to happen. Have you guys thought that through at all?
There's two pieces to CCTP. It's more that how do you make the withdrawals work in the right way? So keeping the deposit functions and liquidity directly on Arbitrum 1 and using their cross communication to be able to enable and disable trading based on that inside, so as we don't end up with some compatibility with the Orbit chains is there. I feel like we're still fairly early with that infrastructure pieces. I'm not a huge fan of focus on chain and develop your own chain. I feel that's that works for a lot of people because the narrative is that that's where you create the value. But in 10 years' time, I don't want to be discussing chains. I want to be discussing how do we bring the hedging of tin into the right place so as we can access Indonesian markets or something. That shouldn't be it. So if you think of us as like Amazon came and put its marketplace together, so Jetstream's like our first market, and then you've got the ability to put all your shops and bring every other supplier in. So that's Pascal's ability to put other platforms into place. I don't want to have the conversation about the whole AWS piece that sat underneath and behind that with the people who are making a decision about what they want to trade. I certainly don't want to be making a conversation about the protocol number on individual routers with people. That's infrastructure that puts people off getting involved.
Yep, I agree 100% there. Which brings me to my last question about chain, and then we'll move on. I am curious though. So you mentioned throughput, right? And the pressure that was putting on like Arbitrum. So Solana is marketed as this high throughput chain, the highest throughput you can get, et cetera, right? So why did you choose the EVM, I guess, to build this on versus the SVM, or was it that big of a decision for you guys? Was it with the CCTP?
Particularly 2 years ago, it wasn't. But then uptime's everything. Imagine if a market's moving and you've got a big trading position on and it goes out for an hour. You're dead in the water. So uptime and reliability is everything. Arbitrum had a really big push into supporting Rust, so their stylus products, and we were one of the people that worked through that with them. The key piece for us there was being able to write object-oriented code. Means you can test components separately. This is big. It's 77 smart contracts. It's really hard to put this sort of infrastructure into a smart contract. Tons of engineering to get it into the size, particularly with the VASM and the stylus API sat in each one of those as well. They were very supportive in getting all of that normalized in the right way, and therefore we're able to use all of the normal standard library stuff, all the fuzzing tools, things that just aren't anywhere else. Everyone's gone in a custom direction, and they've really supported the standards. So that was straightforward. In the medium to long term, I don't think it matters for clearing solutions if other people start to integrate because they can run the matching on some other chain and pass it in. Don't care how they do the matching. I care where they put the risk at the end of it. We really just want to own that risk piece and demonstrate the rest. But we're still very much at that surface level, like the Solana 2 million transactions. It's 2 million transactions if you count every single interaction, every push, pop, pull, push as an interaction. All of those little binary things. NASDAQ's running at like 2.5 million transactions, and when they say transaction, they mean end-to-end trade, which is probably 1,000 transactions when you turn it into smart contracts and put it through Solana. So there's still 1,000x difference between these guys. So there's a big distance to go to be able to get to that. And I think we all know that Hyperliquid has this on-off hybrid piece going on. So the question then is it centralized? Is it decentralized? Because if it's centralized, if it's run off chain, it's not hard to get those sorts of throughput numbers. Is it really on chain? Which bits are on chain? How does it interact? It's essentially on chain from an interaction perspective, and off chain from a throughput perspective.
Gotcha. No, it makes sense. Let me bring us back to Pascal for a minute. I just want to thoughts on. I found it actually very interesting. Let's talk about Pascal. One thing I wanted to ask earlier that I didn't ask, but you started talking about RWAs, right? Mm-hmm. And how you guys want to own the risk. You spoke about that a second ago. I'm curious though, like one of the things that I've heard in terms of bringing more RWAs on chain and different types of RWAs is one of the big problems they're running into is how can they actually make sure that there are tidy liquidations for these assets, right? Particularly with something like, I don't know, private credit. Take ACRED, for example. I think you can only redeem ACRED like once a quarter, and it's only a certain capped amount. So like, how do you bring that on chain and then properly liquidate it? How do you enable margin on something like that? That's just one example. But like, how do you think Pascal can maybe like help like smooth some of these problems around liquidation, around these different risk profiles of these different RWAs that you guys are like uniquely equipped for?
So I think the key thing is that when you're trying to lay off risk on RWAs, it's normally done with derivatives. And if you don't do it with derivatives, then you face the fact that you need to go into those complex processes. But if you're laying off the risk by just trading a future on it, and the future is determined against the price and can be transferred between people at fair value, then you can lay off your risk very quickly. Even if you're holding the asset, you're no longer holding the exposure to the asset, and somebody else is, and then that moves around between the different entities. So that's how futures market tends to do it. You could also start to take some componentization pieces. There's some work done on CDOs in that space, and there's some work done on CDSs in that space. There's some really interesting papers I was reading about how to break down those different components, quantize them, and allow people to purchase different aspects of risk for different components, put them in together in packs, and then bring them into one place where you could face a Cayman's entity to do that as your counterparty if you're a bank, and from our perspective face something that feels like it's on chain. And it is on chain, it's just got the right default setup behind it. That means people aren't allocating balance sheet, they can't do. But that's hugely down the line, technical, complex. I think they're solving the wrong problem today. A lot of these guys, they are trying to solve a problem that the marketplace kind of gave up on and wrote swaps and futures on top of, transferred the price risk out of it, and said that default risk piece is always going to be complex, but let's transfer the price risk away. So if it starts to get complex, you shift your price risk off to somebody else, and they buy it at a discount, and they carry the difference between the two.
Gotcha. No, it makes sense. It just struck me because, I spent a lot of time in like the RWA space, and like that's one of the main things that everybody keeps focusing on. Like Horizon just came out. I don't know if you saw that with Aave, their new Horizon platform. Now I know one of the main problems is like, how do they liquidate these assets? But maybe they're thinking about it in the wrong way. Is maybe the answer there, right?
If we're talking like, so the eSpeed platform I was working as part of at Cantor is the bonds platform there. It's where the US Treasuries were traded, where the rest of the Treasury markets. It also had a bunch of other bonds and corporate bonds and things around it. These problems exist, but you need to be able to transfer aspects of that risk. And if you can transfer pricing risk off, which you cannot do with perps because funding risk kills rates curves. But if you can do that with futures where there's no overnights, it's just got to decay into the settlement price, then you push off that risk. And it means everything else has time. You're no longer trying to work out how to do that in a mechanic that you have to do today, tomorrow to know what your position value is. You lay off the price risk and you let that work through its process in over a week or so with the right custody entity saying, yep, we've put it into the process, we will wind it up, we'll tell you where it is, but you've pushed your price risk off already.
Gotcha. No, it makes sense. One thing I wanted to touch on here, probably got about 5 minutes left, so I wanted to give you time to talk about this. We talked about, you mentioned Hyperliquid. Is it decentralized? Is it centralized? For Pascal, how are you guys, I guess, viewing decentralization? I think it comes in many forms. I think it doesn't make sense for everything necessarily. But how are you guys thinking about decentralizing the protocol or ways that you can do it effectively?
We're pretty maxi on that for where we want to be. We want to really try to have governance and decision making through the token. We want to have all of those operations running in a way where it can be spread across multiple different places. It can be verified where it's running. Where we're maybe a little bit more flexible is on the platform side. So when somebody builds a platform on top of it for a particular set, so if you were talking to, say, Horizon, and Horizon launched their own system, they'd launch a platform. They would go and put some futures on assets that they've got on their platform in there. And then they've got like a menu of the different rules that they want to take. So they could take a DeFi maxi approach, let everything run on the protocol right down to the allocation piece at the end of the default waterfall, or they can jump into different levels and say, actually, transactions above this size that are withdrawals need approval. We're going to whitelist the entities that have got access. Going to have a market supervision layer where the oracles have manual inputs on them, and they can take that as far backwards and forwards as they want. And that enables people in the TradFi world that don't trust on-chain protocols to know that there's somebody sat there with a handbrake and they can get involved if they want to use it for their mechanics. And it means that people who want to create something for a DeFi protocol where it's fully on-chain and everything's verified because none of them really know each other, that's possible as well. So Pascal at the center has to be some subset of that, a collection of tools that can be generated in different mechanics dependent on the need of that platform, but where all of the core infrastructure, all the movement of money, all the checking is all decentralized. You don't have to choose USDC for everything on Pascal either. We've chosen it for Jetstream, but if somebody comes along with their own stablecoin and says, okay, we are textiles market in Kyrgyzstan, we're going to use a locally benchmarked this, or we are the UAE currency is pegged to the dollar. So if somebody in the UAE created lookalike securities in the UAE for stocks and used the UAE stablecoin that was dollar pegged, you could trade all of that stuff legally in the UAE and push it out. And the dollar's not involved in the slightest in it. So they could run and do that probably down a nice little legal route if they were set up in the right place with the right access. You can take this in multiple different ways.
Gotcha. No, makes sense. On the token side of things, I know TGE is coming up. Anything you want to touch on there in terms of, how can users get involved? How can they get exposure to it? And in terms of like the token, you mentioned governance. Can you touch on the utility? Like, is there any other utility for it other than governance? And if it is just governance, like what exactly are you allowing people to control, I guess, in terms of the protocol?
Yeah. Okay. So first up, TGE is on Tuesday. We haven't set a time. We've got a few of the influencer things where we're going to do some parallel casts on X with some of the big people at the same time. So as we manage to get attention, the float's very low. It's about 6.5% unlocking on that day. So it's not a huge amount. I think the KOL piece is about half. So a point. So it's not that we're not expecting masses of negativity around that. We are definitely going to make some supply available at low prices near the beginning. So as people who genuinely want to come in early and get some of that, there will be some aspects of that. We expect that to be gone fairly quickly. Our last round, our last tickets have been at 50. So we're not at some 300 million FTV. We aren't trying to be in a place where we've gone and raised at some crazy number where we can't see what the ROI would look like for people who come in afterwards. I want the people who come in early. Now, if there's a bunch of sales pressure that comes afterwards, market action, you can't control it. Now, I can't line up the bids and offers at the same time for everybody. Someone should build the auction systems to do that, but that's for another day. So the price will go up and down around that, but I want to make sure over the medium to long term there's plenty of value. And if we get any of these FX platforms or interest rate platforms from TradFi using this as their base, those returns look really good, but they're over a decent period. We are going to offer some staking stuff, so there will be some staking rewards for people who are going to lock it up to help us see Jetstream through that. There will be some rewards. We really want to see some rewards from the other platforms that are launching, where they will, for people staking on this and holding that price in the right place, that they will get some cut of the things coming in. We're going to do that with Jetstream, but that's up to the platforms individually, but it brings attention to your community in the right place. The Jetstream community, at some point we touched 6 million people across all the different channels, so it's huge. So only 1,000 people on the on the Twitter on Pascal. The count out of those that are smart is already in the 100, like 200-300. I had backwards and forwards with one of the C-suite of Swift earlier on LinkedIn about it, and a very large Dutch VC, but also options trader, reached out as well. So there's plenty of interested people in it. So we're going to really try and build that up over time. So that's get it out there, get it running. Also hits all our decentralization goals, means the ownership's there. Bringing the voting online is going to happen months into this. So we need to get through that, get stable. And then the voting, there's some variation in the Swiss law where the labs is at the moment, and we want to make sure that we're cleanly through that position. But I'd like to see councils set up to make some of the decisions, because I think if every single thing goes to a vote, well, I've got a lot of connections into Switzerland. It doesn't work out very well. The last canton to give women the vote, because they voted locally, was given the vote in 1991. So that feels far too recent. So you can go too far down that line, and we saw all that with Polkadot. So I don't want to be in that position. So we're thinking councils, major things and proposals going back through for anything to come in there, or incentive models, but some balance between those two to roll that forward, that's essentially constitutional, get voted on. but the market then gets run by that DAO. Hopefully, over time, we will see larger market players around taking positions because they want to be able to uh, push the direction of the build for new risk models and new systems in the right direction.
Yeah, no, it makes sense. Yeah, one of the things I really like kind of this idea of like the front ends that are built, the apps that are built on it. Maybe allocate some portion of their TGEs towards like stakers. That's really interesting because I think Liquidity is trying to do the same thing, right? Where they've got all these friendly forks that are kind of like these front ends of Liquidity,
Mm.
but then they're kind of pledging like a certain amount of their allocation back towards the bold stakers or the liquidity stakers, and I think it's some parallels there. So I think it's interesting. Yeah, this is awesome, James. I really appreciate your time. I know it's precious. Um, to wrap things up, if you're listening to this or viewing this at home, check out the show notes. We'll definitely link you guys out to where you can find Pascal, where you can find James and the crew. And definitely keep an eye out on Aliyah research as well. We will be coming out with some research on Pascal that will hopefully help kind of contextualize just how broad and how massive this could be if executed well, which I know James is working hard to assure that it will. But other than that, James, really appreciate your time. Thanks for coming on.
Excellent. Thank you very much, Kirk.
Absolutely. All right, everybody. We'll see you on the next episode of Proof of Vision. Take care.